Hello, this is Ruben from Property Solvers, and welcome to another podcast. I'm here once again with James. How are you doing, James?
I'm good, Ruben. How are you doing yourself?
Yeah, all good, all good. So I think this podcast is going to be pretty short because we're going to be continuing pretty much the discussion of what we started on last week. But the topic is going to be on off-plan investing and whether it's a good idea, particularly in the current market. So I know we mentioned a few kind of bits and pieces on the subject last week when we were talking about investing abroad. But perhaps we can focus a little bit more on doing off-plan investing in the UK. So my initial thoughts on off-planning investing anywhere really across the country would be probably a hard no. I just kind of see there being far too many risks, and I've just heard too many horror stories over the years of investments that have gone wrong, or people putting in, quite hefty chunks of money into these projects that, have got no real kind of predictable outcome. And there's a few reasons that I would kind of mention, but perhaps James, you want to start by giving your thoughts on the whole subject, because I know you've done it a couple of times, right, in the past?
Yeah, I bought off plan before, Ruben, and it hasn't worked out that well for me. But I have learned that there's different stages to the property cycle where off plan works better than others. So it's not really I wouldn't say for me, it's like a definite no at all points. Because I mean, for example, now I wouldn't touch off plan because I feel like we're in a very mature stage of the property cycle. And obviously, while the development is being built, there's inherent risks that you have to deal with because, there's various things like, as you said, like the developer could go bankrupt, like the development might never be finished. But more of a risk right now, I would see, is when prices are sort of at a premium at the moment and the market is a little bit uncertain and it's kind of transitioned from a seller's to a buyer's market. There's a high probability or risk that prices are going to drop in the build period. So by the time it comes to you actually completing on the project, the value of that property might be less than what you've been pitched at originally or what you've bought it at, because obviously developers can be a little bit optimistic in the values that they feel that they're going to get for their flats. And also, as we spoke about in the last episode, there's also a new build premium, which we typically would say is in the region of like 10 to 15% of the sale price, which is similar to sort of buying a new car straight off the forecourt. So that's one of the things I would sort of say straight away about sort of investing off plan and sort of paying attention to where you are in the market cycle. And then after that, there's a range of other risks that you have to look at.
Yeah, I mean, I was going to say you also want to know a little bit more about the developer. How much experience they have, their credentials as as a developer, who they're working with in terms of their construction. You can check all of these kind of things out on Companies House, but a development can go wrong in so many ways. We've only done kind of small scale developments, but there's so many risks, particularly with larger projects. And if the developer isn't capitalized enough, or they're working with a dodgy construction company, so many things could go wrong. And then to the fact sorry, James. Yeah.
Sorry to cut in there, Ruben. Just on that fact, even if they are properly capitalized, at the moment with the way interest rates have gone, I mean, if you've started a development let's say a year ago and it's like a 2-year build, during that time, it's highly probable that your lending rates would have increased, and sometimes massively. So obviously, while they may look sort of liquid and solvent at the start of a build, things can happen during the build, particularly in the current climate, the way it is now with interest rates, where suddenly they're actually insolvent, which obviously increases the risks massively that the development is going to get finished. But sorry, Ruben, I quite...
Yeah, no, that's a really, really good point there. And also, you want to check when they actually purchase the land. So if they bought the land at the peak of the market, let's say, 2019 to 2022, it's highly likely they would have paid over the odds for the land unless they bought it as a distressed sale or something like that, and then added to that, you've had all these inflationary pressures on cost of materials and labor. So all of that needs to be kind of thrown into the pot. And so these developers need to be earning quite a hefty margin, not only to pay themselves, but also to pay their investors, and I do know there's quite a few of these like crowdfunding projects, for example, that have gone belly up because of that fact, because the developer hasn't really factored in, these kind of stress tested figures into their calculations and then punted out these deals, working on kind of top market prices, when there's been all these other factors that have, come involved in projects in the last few years. So development is always risky, and I think
I think you have to look at the valuation, so like when you're actually trying to value or evaluate a new build deal to see if it's a good one or not, a lot of the time the developers will send you comps, like comparables of other buildings that are sort of being built or they come into sort of final stages of development. But like what you actually have to look at when you're evaluating a deal is the secondary market, like properties like flats that have already been built. Like what are they actually selling for? Because like there's a huge difference between what developers are often asking for at the end of a project and what flats are actually selling for. So that's something that you need to look out for. And also the key to that is, like, sort of aligned with that is looking at what the supply is like, both in that development and in the town or city that you're thinking of investing, right? So sometimes, for example, a developer will build a project and 80% of the development will be sold off plan to investors. So when that development comes to completion, you've got all these investors all trying to realize a gain and sell out at the same time. And there's a huge oversupply of these sorts of properties on the market. So basically, like, how you negate that is you got to look at, like, what is the split between owner-occupying buyers, so people who are going to live there, and investors who are just speculative investors who are looking to flip those deals. So that's kind of one of the things that you can look at in the development itself. And then in the town or city where the project is being built, what has there been loads of similar properties to this being built in the city? Is there a huge oversupply? When you go onto Rightmove and you look at like new build flats or like say 1 or 2 bed flats, in some of these city centres like Liverpool or Manchester, like at one point they were absolutely flooded. I mean, the supply has been eaten up to a certain extent now, but there's still a lot. I mean, there's been a shitload of new build in Manchester the last few years, so all that supply, like when supply exceeds demand, basic economics, the price is going to drop. And that certainly was my experience when I actually bought an off-plan property in the last, during the last bull run, I guess, like property bull run in Manchester City. I kind of made all the mistakes, I bought it speculatively thinking I could hold it for a couple of years and then flip it, there's stage payments throughout these builds where like you put a certain amount of money down at the start. It might be a very low amount of money, like let's say 2% reservation fee. And then throughout the build, there's like multiple stages where you're supposed to come up with more of the money. And like a lot of investors at that time, and I mean, this is true of nowadays as well, they thought they could, including me, they thought they could get in early and then flip it like before completion to like another investor who's coming in at a later stage of the build. But the reality is that market didn't really exist, because when we tried to flip them on, there was just no buyers. So what happened was when the development was complete, I mean, there was a load of units in this development as well. And that's another thing you need to look out for, the number of units in a development. But there was a lot of units. There was a hell of a lot of them owned by investors, and everybody was trying to sell on completion. you know. So there was massive oversupply in Manchester city centre. There was a massive oversupply on that particular development. At the time, I managed to get out of my flat just by like basically staging it.
Yeah,
That's
remember.
a whole different video, like the power of different podcasts, like whether it's worth staging a property or not. But yeah, I mean, for me at that point, staging that property helped to sell that flat. So I managed to get out of that flat. I broke even. I was able to walk away. I think I sold it 170,000, and about 2 years later, those same flats were going for 100,000. So that's what can happen. Like that's the reality of the risks in off plan if you fall victim to those two major problems of oversupply.
Yeah. I think what happens is these developments get sold. Like the marketing is great. You know, you look at them and you just so many boxes are being ticked when you look at these brochures. You know, you're like, oh wow, okay, so Sheffield City Centre needs this, needs that, all this development that's happening. You know, there's a massive undersupply of property, and there is an undersupply of property across the UK. You know? We all know that, but flats in city centres, you know, you've got to be careful about what you're actually kind of getting into, because the real demand for property in the UK, I think, is more the kind of family homes, you know, like the 2-3 bedroom houses with gardens and that kind of thing. So that's where the real deficit is, you know. But
yeah, I'd say it also depends on the location in the country, right? Because like
yeah,
let's say in
London's
London,
yeah,
like there's more of a demand for flats and new build flats in London than there would be, let's say, up in Manchester or Sheffield, because you can buy like houses so cheap, whereas like houses in London are extremely expensive.
yeah.
So it also depends like on the location really. But sorry, Ruben, you were saying?
No, that's definitely a fair point. I mean, London's limited for space as well. The possibility that you may have, you know, buying in kind of the Midlands and the North, for example, is that, you know, if you do buy an off-plan property and you do end up having to complete on it, you know, you might be able to, you know, exit by refinancing the property and moving on to a buy-to-let. But it might be tricky in this current market, because buy-to-let is so hard to secure. Buy-to-let financing is so hard to secure, you know, so it's just a tricky.
Well, again,
you know?
yeah, I mean, you've reminded me of another risk there, and I hope we're not coming across as too negative here on new builds, but this is just the fact of the risks that are out there. Because one of the things that can also, like obviously, as you said, I mean, rates have went up. So these ones, like you have to look at the rental yields for these flats, right? And sometimes while the rental yields may look okay, obviously if there's oversupply, the rents will drop. But I mean, added to that is the fact that a lot of these new builds, they've got quite expensive service charges and ground rents attached to them, particularly if you're looking at like a really swanky building with like a swimming pool, gym, concierge service. Like all these things come at a massive cost. Like, and we've seen, you know, buildings up north with like 7,000 a year service charges to cover some of these facilities. So obviously, even there, like if you've got like a rent that looks quite high to the purchase price, or the yield looks quite good when you look at a like sort of take a bird's eye view of it, when you actually dig down into the numbers, you'll find that the net yields are actually way lower than you first thought, because once you take into account the service charge and the ground rents, they no longer stack. And obviously added to that, the fact that rates are so high, again, it's another stumbling block for some of these fancy flats. And you know,
and then also there's
they
the
also kind of,
costs as well, right? The like cladding and all that kind of stuff. That's kind of boosted up. You know, these freeholders are sending these massive bills over to leaseholders, you know, for works and, you know, all these kind of fire regulations that.
yeah, I mean, a lot of people have found themselves in really difficult position with all that cladding stuff. You know, it's absolutely decimated the value of some of these new builds, where they can't get a mortgage because of the cladding, and they need. Actually, it's a very good point, Ruben, because if you're ever buying a new build flat, you need to make sure that it's got an ESW1 certificate, which is a fire safety cert, because without that, you won't even get mortgage lending. And when it comes to completion, you know, most people will need to fund or get a mortgage to pay for that flat.
Mm-hmm. And there's no real end in sight for all that stuff. I thought that the RICS were kind of looking at, you know, dealing with it, but it doesn't seem like anything's happening with it at the moment, you know. I guess there's other priorities with the election and all that kind of stuff. But yeah, it's
I think it takes a long time to work through this, right? It's
yeah,
like massive problem,
yeah, for sure.
and it's taken years and years to sort out.
Yeah.
But yeah, without being too negative, I mean, look, on the positive sides of buying off plan, you get to get a beautiful, shiny new flat that's amazing for your ego. You can show all your friends, bring them out for a night out in Liverpool or Manchester, have an amazing time, you know.
Yeah.
Occasionally, look, you do find deals, and the thing is with new build flats, I think going back to like market cycles, if you get involved in off-plan flats at the right time of the market cycle, i.e. in the growth phase, so you're just coming out of recession, you're going into the growth phase of the market, you can actually make huge amounts of money in off-plan. I know people personally who used to do that, and they used to take contracts for like 20 flats off one project or one building. And they did it at the right time in the market. They'd sell them to investors, and they were making huge amounts of money. They were also selling them to like foreign investors, like selling them in China or whatever. And obviously developers themselves, like they're selling new builds, they're making a bloody fortune out of it. So it's not all bad, but like obviously here on the podcast, we're just trying to point out some of the risks for newer investors, maybe that were in a similar position to myself when I started off. And yeah, these projects, while they can look and feel very good for your ego, sometimes they're not as good for your bank balance.
Yeah. So yeah, due diligence to the max, I would say. You know, and just at the moment, probably wouldn't recommend it. You know, there are some companies out there that are working with developers that, you know, sometimes have surplus stock that they're selling. You know, perhaps they've built 20 units and there's like 2 or 3 that they just need to sell. You know, you might be able to pick up a deal through those. I know
Well, there is deals for those now, Ruben, and that's a very good benefit that you picked up as well. Like obviously with any sort of risk comes opportunity as well. And actually, well, we spoke about some of these developers and the difficulty with the market at the moment. There is actually an opportunity to buy distressed off-plan sales at the moment. I think those opportunities are going to increase over the next couple of years. Obviously, it's a little bit different because it's kind of more moving into sort of below market value stuff as a subject. But certainly, there's people who buy, like you said, end of run units off of development, or even we've been offered whole developments ourselves this year at significant discount. But I think what we were speaking about more in this podcast, we're more alluding to sort of off-plan speculative.
Yeah. And with these properties, we always look at them we tend to look at them a bit more from an investment point of view, like buy to let, like almost kind of they say to ourselves, okay, if we can't sell these units because we are in a tricky sales market at the moment, can we actually let them out? And then as James mentioned before, you know, we need to take into account the service charges, you know, the local market and all that kind of thing, you know, and whether it's worth, you know, leaving kind of 30-40% into the deal for the rental returns that we'd get. And that's going to be quite difficult in London because the yields are just still pretty low. Even though rents are going up, the yields just are not there at the moment.
I mean, what we try and do is stack it on the net yield. So like once you've taken off the service charge and ground rent and any other charges associated with the building, like what's the actual yield on the net rent? And if the net rent covers all the mortgage repayments and leaves you enough cash flow that it's an acceptable return on your money, then we'll go ahead. But yeah, always look at the net yield rather than the gross yield.
Good stuff. Okay, yeah, well, that's a short conversation that we've had today, but an interesting one nonetheless, for me anyway. I hope you're all enjoying these podcasts, and yeah, please like and subscribe. And any topics you want us to discuss, we're more than happy to. Yeah, feel free to drop myself and James a line. And yeah, we look forward to speaking again soon. Take care.
Thanks a lot, guys.
Thanks a lot.
Thanks.
Thanks. Bye.